Well, hello everybody. Tom Galucci here. Just welcoming you to the next installment of the 12 days of TMC and our afternoon session, retaining and releasing strategies and best practices for servicing retention. I've got a great host of discussion leaders lined up for you today. And that said, we do want this discussion to be as interactive as possible. So highly encourage our attendees, whether you're connected directly with us in Zoom, or you are streaming this via the Whova application, want to drop your questions in either the Q&A or the chat functions, our team at TMC will see it at our side and be happy to share those out towards tail end of today's discussion with this great group that we've got here for you. Quick programming note, just as a reminder, we're going to be wrapping up today's agenda after this session with a great industry keynote with Debbie Hoffman, blockchain expert and CEO of and founder of Symmetry Blockchain Advisors, and that is sponsored by our partners at National MI. So on that note, let's go ahead and drive right into today's discussion. I want to introduce the folks to be leading today. And first off, from TMC's longtime partner at Phoenix, we have both Vice President of Trading, Kelton Carter, as well as Executive Vice President of Trading, Stephen Fleming. And then we have a pair of lender members, subject matter experts joining as well. We have Senior Vice President of Business Development from Union Home Mortgage, Al Blank, as well as Bob Hamilton, Vice President of Mortgage Loan Servicing at Glacier Bank Corp. So without further ado, we'll go ahead and jump right into things. And Kelton, I'm going to turn it over to you to take it away.
Appreciate it, Tom, and thanks for having us. So thanks everybody for joining us on this Friday afternoon. So, retaining MSRs has always been a hot topic of discussion. We talk about it in a rising rate environment. We talk about it in a falling rate environment. We talk about it everywhere in between. Today, we've brought myself and Stephen Fleming from Phoenix to discuss a particular MSR retention strategy that we've seen a tremendous amount of success with in the past. We've also brought in two real experts, Al and Bob, who are living and breathing these discussions every day to give insights into the enterprise level discussion to retain or not, and their experience in doing so. So to kick us off today, I'm going to turn it over to Stephen to give everybody a quick MSR market update.
Hey, thank you, Kelton, and good afternoon, everyone from chilly Denver. Yeah, it wouldn't be an MSR retain release discussion, at least some degree of an MSR market update, in as much as, well, that's why Al calls me whenever I'm in trouble if the market's not behaving well, because it impacts those very retain release decisions. So, I guess regardless, I get that call anyway. But the market does impact it. So, could we please advance the slides? Maybe we can do one more. And yeah, I'll start here. This is just a very brief kind of setup, and then I'll jump to the subsequent three before I turn it back over to Kelton. So I would say the theme for 2020 and likely for 2021 that we've seen on the Phoenix desk is that of ownership. Ownership in light of, it comes to us in a variety of ways. There's not a one size fits all. And so, I'm not going to go over all these bullets here word for word, but effectively what we try to impart is when you find yourself as an owner of MSRs, and I think this year, as I mentioned, there are a variety of that you could achieve that special designation of being an owner of servicing rights, but it's either through opportunity, through strategy, through necessity, through liquidity, through execution, and of course, there's a lot of overlap between those arenas. But we've seen the focus on MSRs this year is frankly be the highest of any year that I've been on the Phoenix desk, and I guess now what is almost a decade. We're continually looking at ways in terms of what's the best strategy for MSR analytics and what's the secret sauce. And well, I'm not sure we found that. I think we have found some pretty salient observations that Kelton's gonna walk us through, and the specific tactical retention piece of it with some analytics behind it. So let's jump to the next slide, please. All right, so it's one of my favorites, pricing. We have had ourselves, I'd say, 3 phases to 2020 so far. Phase 1, let's just say that encompassed March and April. And we all know where we were then. We were coming off, in the servicing market, that is, we're coming off a very, very strong 18, 19. coming off, I'd say, the strongest January we've had in years into a February. And, when Kelton and I were looking at forecasting out, we were just excited about the rest of the year for the number of trips we could make and for the 5 multiples that we would continue providing our clients. Well, it turns out we kind of struck out on both of those. But phase 1, I'd say in March, was where as the war just began on servicing rights, we saw pricing truly on Ginnies, and this slide is conventional, the next slide is Govies, but drop, I would say, to negative in some cases, at best 0 on Govies, and on conventionals, call to the 1 multiple range. Phase 2, I think, is more of the summer. This is when it sort of feels like the trepidation with which many of the top buyers kind of approach the models began to ease off. We were all talking about negative cash flows for a period of time there if a loan went to forbearance, or just thinking about like 30% unemployment. And what would that do? Like, how would that manifest itself in a given cash flow discounted NPV? And we saw in the summer that it seemed like, although extremely serious, the catastrophic model scenarios weren't going to take shape, weren't going to come to fruition to that degree of stress that we had thought. And that's where we saw, I'd say, prices pick back up on the Govy side, is call from 0 to now hitting a 1, which, hey, was great at the time. And on the conventional side, probably getting more into that 2.5 space. Fast forward to where we are today, and I think Kelton and I kind of describe it as, this feels like phase 3. And it's in a way, it's let me try to get this right. It's like a step function, for how we've seen prices and the model evolve over 2021. But phase 3, I think, is where we're now seeing, and it's evident here by this very, very evident V. And you could jump to the next slide too on the Govy, so we can get a look at that. Thank you. But is a very much a pronounced phase 3 of where, wow, that was a quick rebound of pricing, but we're not where we were. So now conventionals, I'd say, are hovering in the 3.5, but we are aware, and we've seen some bulks across there from our desk and from others, where we've gotten some bids that have eclipsed that. But generally, I'd say, healthily now in the 3s, generally around 3.4, 3.5 on conventional multiples, and with FHAs now getting back up to that 2.5, 2.75 range, which admittedly, as you can see in this graph, is still below where we were in the past 2 zeniths, I would say, of MSR pricing, but nonetheless, very encouraging for where we've been. So now, looking forward from here, like, does phase 3 continue well into the spring, or are we in turn for 4s? Are we going to get a 4, for Christmas, a 4 multiple? I think the general thought is this is a moment where we're likely going to stay at these levels for a period of time. But what's most encouraging is that the trend lately has been our friend, but the trend, not so much even of pricing, but of quantity of buyers, both conventional and government, has increased steadily throughout the year. And for us, I think we believe Phoenix Nest that liquidity begets price, and that's sort of the precursor to it. And I think with seeing where the degree of participation interest in the asset has only escalated and has sustained since March, since that phase 1, I think we're in store, and what we're hoping for is a steady climb into a relaxation of some of the more punitive assumptions into next year. Now, that being said, of course, we all know what it depends on, and we all know the specter behind us and around us in terms of what we're battling out there. So it'll be eyes wide open, but it's been a very interesting year, and I think it's likely to persist into 2021. I think we have one more slide, or are we going straight to you, Kelton? Okay, so the outlook, what I was just chatting about, and I think in the end, it is going to get on that last bullet, where just to really tie it back into Kelton's is on the flow and on the bulk space. Bulk in particular, we anticipate quite a bit of interest for 2021. We've seen many retention books and portfolios increase quite precipitously this year. And I think while there's a lot of comfort with being long the asset, there's still a lot of strategic need and desire to, in a way, confirm the investment thesis of the price of some of those investments, confirm the opportunity cost that was made there, but then also monetize, periodically to continue to grow, what has been a tremendous growth period for many of our clients out there. So I think with that, Kelton, I think I stay within my 5 or 6 minutes. Let me pivot to you. And we can jump over the next two. Kelton, you're on mute, by the way. And we can jump over the next two slides.
Yep, you're right. So yep, right there. Perfect. So the strategy I'm about to dive into is no way a groundbreaking or new strategy. Retain MSRs when interest rates are low. And if selling is in your strategy at all, sell those MSRs when rates are high. Easy enough. What we really want to key in on are the economics of that decision versus a couple of different scenarios. A day one release of the MSR in a co-issue, or you can substitute that with aggregator execution, or holding those loans long-term or to maturity. So the reason we've put this strategy presentation together today is we are in historically low interest rate environment. There's a tremendous amount of originators out there who have either just started to retain or are now sitting with portfolios that are much larger pieces of the balance sheet than they had initially planned at the beginning of the year. For those of you on the call who do not retain or do not have the ability to retain yet, some background for you is that when COVID started in March of 2020 and the mortgage market went a little haywire, the execution of selling to the agencies and retaining the MSR, or said another way, the economics of holding the MSR versus releasing it, was the premier execution by and large. And we saw a lot of originators start to put meaningful amounts of product on their balance sheet. That statement holds mostly true today. So what you see here are the results of a scenario analysis that we ran on the three potential paths when selling to the agencies. Selling co-issue day one, retaining the MSR and selling a bulk package within a couple years, and finally holding the portfolio long-term or to maturity. One thing to note here, the statement about holding to maturity is definitely a moving target. Yeah, the average life of an MSR is around 6 to 8 years. So while this says hold to maturity, you can look as it a long-term hold. Obviously, the longer you hold it, the more risk you have from outside factors. So I'm not going to spend a ton of time here. I'm really going to key on of releasing day one versus holding for a couple years and selling a bulk. So what we've done here is mocked up $1.5 billion conventional portfolio. We did this for Ginnie Mae as well. We're starting with Fannie Freddie. And we'll get to Ginnie Mae after this, but the analysis itself holds true. It's the same analysis, just with the different asset class of Ginnie Mae. So there's several key drivers of this presentation I want you to keep in mind as I walk through this. Number one is the cash flows of an MSR asset are front-loaded due to the amortizing nature of a mortgage asset. Number two is, for those on the call who are not aware, and please realize that I nor we are a tax firm and we're not giving tax advice. We're only pointing out what we have seen in the market. When MSRs are held for more than 12 months from the note date and then sold, we have seen auditors sign off on those MSRs aged greater than 12 months with long-term capital gains treatment. The difference between being taxed at ordinary income and long-term capital gains treatment is about 17% of tax savings. It's substantial, and it is a key driver of this analysis. Now, banks don't get that same opportunity because they're corporations, but we have seen a lot of the independents out there be able to realize this sort of treatment when talking with their auditors. Another one is recapture plays a huge part of this analysis. With MSR speeds where they are today, recapture assumptions are some of the main drivers of buyers' models in the market, and protecting your portfolio by refining your own book is one of the better economic scenarios that you can have in this environment. So in this analysis, we've assumed the following. You are recapturing your conventional book at 20%, and the gain on sale on the origination is 100 basis points. Another huge piece of this is we are assuming a rising rate environment over the next 24 to 36 months. Finally, this is making the assumption that this holder has a subservicer set up. If you're servicing in-house, obviously the economics of this will change based on your own cost of service and everything like that. So a couple assumptions for the conventional. We are assuming today that MSR co-issue multiples are 3.25, and in the next 24 to 36 months, rates will rise and bulk pricing will be around a 4.5 multiple. So what I'm going to do is walk you through this table here. So I'm going to start at the top line here, and we're going to pay attention to the co-issue and retain for 2 years and sell a bulk. So we're starting with a $1.5 billion portfolio, and these are just dollars. The bottom 3 lines here are simply exactly what I'm talking about, just in terms of basis points or pricing. So We'll walk through this. So the total cash received of selling co-issue day one at that 3.25 is a little over 12 million. The total cash received for retaining 2 years, collecting the servicing fee, and then selling a bulk at that assumed 4.5 is a little over 17 million. So we'll go down to the next. So the incremental recapture after tax with that recapture income baked in there. Obviously, co-issue day one, there is no recapture because you're releasing the rights. We're assuming that you're going to generate an additional, call it $500,000 from the recapture of your own portfolio. And then down to the next line. So total cash received after tax with recapture. So co-issue day one, this is where the tax piece plays in. Co-issue day one is going to be taxed at ordinary income. So that 37%. So you've got, just under 8 million. Retaining 2 years, there's two different tax pieces. Your servicing fee that's coming in over the 2 years is going to be taxed at ordinary income, but that sale of the MSR at the end of the 2 years, assuming you can get the sign off from auditors, is going to be that long-term capital gains treatment. So that's going to generate, call it 12.5 million. That's an increase of almost 60% in gross cash proceeds. But we want to look at that from day one cash. We're going to use a net present value to discount that back to day one. So obviously the next row there, co-issue selling day one doesn't change because you are generating the cash day one. Using an implied discount rate, retaining for 2 years and selling the bulk, that's going to generate day one cash around, just around $11 million. So when you're looking at that, that's almost a 40% increase in discounted in day one cash by utilizing this sort of strategy. And again, this strategy holds true as rates continue to rise. So let's go on to the next slide. So this goes back to my point earlier about the MSR cash flows being front loaded. This graph demonstrates that. So the attractive piece of this strategy is the economics of the first year of holding the MSRs. When you discount it back to day one, you can see that you're recovering between 32 and 45% of the discounted cash flows back to day one within the first 2 to 3 years. When you add in recapture, the all-important recapture piece in today's environment, that number increases to 37 to 52%. The sales strategy here becomes attractive because we as advisors have seen that the market does not punish, buyers do not punish a portfolio that is aged 2 to 3 years when it's being priced. For example, we had a portfolio back in 2018. So if you think 2016, 2017, rising rate environment in 2018 and the flurry of activity we had on the bulk side, we had a portfolio that was about 3 years old, traded at a 5 multiple. It was 75 to 100 basis points out of the money, but the whole premise of that is you're receiving, 30 to 40% of the discounted back cash flows within the first couple of years of holding it, and turning around and selling that for a 5 multiple is a very attractive strategy. The whole premise of this is retaining when rates are low, selling when rates rise, when the prepay propensity is very low of the asset. Banks, independent buyers of mortgage of MSRs love that trade and pay very well for it. If you continue to hold the MSR asset long term, you start to see diminished returns as the asset amortizes. There really is that sweet spot of holding and selling, should it fit into your strategy, in a rising rate environment within that first 2 to 3 years of holding it. So let's move on to the next slide here. So this is simply a scenario analysis. So, there's a lot to digest here. I understand that. But so our left axis here, our left side is the bulk pricing. And our top axis here is the co-issue pricing. So if you look at the bulk pricing, we're assuming that 4.5. If you look at the co-issue pricing today, we're assuming that 3.25. Where those two intersect, that's tying back to our scenario analysis a couple slides ago of generating an additional $3 million of discounted cash flows back to day one. You can use this if you think rates are going to go up more. Bulk pricing is going to rise. Co-issue pricing is going to rise. Rates are going to go down. You can use this table to shock, this analysis a little bit. Now, at anybody that's on the call, we are happy to run this analysis with, different assumptions based on what you're doing. You just reach out to Steven or myself, and we can alter this to really fit what you're looking for. So go on to the next slide, please. So this here is the exact same scenario we just walked through, but for Ginnie Mae. The difference here is that we are assuming that Ginnie Mae pricing today, or well, we know Ginnie Mae pricing today, somewhere around 2.25. And then in 2 to 3 years, assuming the rising rate environment, Ginnie Mae bulk pricing will be 3.25. So I'm not going to walk through everything again, but if you look down here at the fourth row, so total cash received, net present value with recapture, this is an even more attractive strategy on the Ginnie Mae side. You see that instead of the 40% increase in discounted day one cash flows on the conventional side, we're at 53% on the Ginnie Mae side. So let's run through, skip to the next slide. Again, same thing as on the conventional, front-loaded asset. You're receiving more of the cash on Ginnie Mae. It's a higher cash contribution due to the higher servicing fees. Again, recapture, very important. So move on to the next. And then again, the sensitivity analysis. And if anybody on the call wants to see this and get the presentation, if you haven't gotten already, and walk through some of these scenarios, happy to do it. Just reach out to myself or Steven. So let's move on to the next. So here are our assumptions. I don't expect anybody to pay too much attention to these, but the one thing I do want to touch on before turning it over are the risks associated with this strategy. It is not foolproof, and we are not by any means advocating everybody utilize this strategy. So a couple risks. Rates fall, they don't rise. This scenario analysis table will show that. If rates fall, bulk pricing goes down, co-issue pricing goes up. Releasing co-issue day one likely is the better scenario for an originator. Buyer liquidity dries up in 2 years. As Steven mentioned, there's a tremendous amount of liquidity in the market right now. So this is not a huge concern of mine, but the MSR asset is illiquid. There are only a finite amount of buyers. So keeping your thumb on the market, talking to advisors that you're using, talking to people that are trading, is key to this, and knowing, is liquidity drying up? Is liquidity robust? Is a big piece of this. We have some other market shaking event like COVID that spikes delinquencies in a portfolio and rattles the mortgage market. Another would be holding MSRs requires cash. And as rates move up, margins compress, volumes come down, originators can be put under pressure from a cash perspective. So constantly monitoring your cash position and projections are paramount to any successful MSR strategy. And so I want to be clear, we're not advocating anybody should retain 100% of your production. We, as advisors, believe at our core that a strategy that utilizes several liquidity options, so retaining, selling co-issue, implementing aggregator bids when they make sense, gives an originator the ability to react to market shifts and not stay ahead of a curve, but stay on the curve, ride the wave of where the market's going, and not be stuck holding a gamble of only implementing one strategy. So I'm going to pause there. So I want to turn it over to Al. So Al, would you mind giving some insights into your thoughts of the hold strategy, the sell strategy, the periodic sell, as your firm has, or if it has, utilized different pieces of this in the past?
So a couple of thoughts. As you guys know, I have been a client of yours since 2000 for the last 20 years, and you guys have been wonderful. And the reason that I have you by my side all the time is because of what the great poet Mike Tyson said. Kelton, do you know what Mike Tyson's great quote was? He's a great, you're on mute, buddy. You're on,
Everybody has a plan now?
Everybody got a plan until you get punched in the face. And with servicing rights, I cannot tell you how many times they have punched me in the face because you think all of a sudden I know which way rates are going, and then the market moves, and then you guys send me this report. They call it a mark-to-market report. I open it up and I call them and say, how could that value have changed? But we love mortgage servicing rights. We think as an independent mortgage banker, you should develop a strategy around mortgage servicing rights. As Kelton said 5 times during his presentation, nothing with mortgage servicing rights is guaranteed. There's a reason, at least folks at Phoenix tell me that when they send me my mark-to-market report and my value has gone down significantly. They always tell me there's a reason for it going down, and there is. And so the values that we're talking about today in the market, there's a risk with them. There's prepay speeds, and recapture helps. It always helps if you have a great recapture system available to you and you have loan officers do it. But there's other folks out there that do a lot of refis that don't keep the servicing portfolio. We think that retaining servicing is a great strategy. We think it's a great tax strategy. We think it gives you the ability to establish what we believe are customer for life relationships with customers. We think if you establish a relationship and service the portfolio, there will be times when you could sell, like Kelton talked about. And, Kelton, I think you were talking about the trade that Stephen did for me 2 years ago at this time. And we had held some servicing. It may have been. And, it worked out like it was beautiful. But the reason I think it works and having you guys help us with the strategy is I'm never thinking I'm going to put $1 billion on the books and I'm going to sell $1 billion at this date, at this time, at this price. What I do is I accumulate them. And then from time to time, you guys will do the mark-to-market analysis. You'll identify a piece of my portfolio that may be time to clip the coupon and get paid for holding that piece of the book. But I don't sell the whole book. I sell pieces of the book when it makes strategic sense. Without sharing details, Kelton, you nailed it. We kept it for about 2.5 years, kept the servicing strip for 2.5 years. Then we picked up about 30 basis points increase in value, and we got to take it as a capital gain, not as a ordinary income. It was beautiful. Now, last year or so, there's been times when I've looked at the servicing book and said, holy cow, it's prepaying, values are down. But you can't, I never look at the value of the portfolio and say, just because it's marked to market at a certain level that my value has changed. The value I have is in the relationships with the customers and the potential value in the servicing portfolio. So I think you got to pick it as a strategy. I think you've got to be committed to it. I think you manage the asset over a period of time. You would be crazy to try and manage the asset on your own. You need market intelligence all the time from professionals who live the life, who have great market intel, who could give you some advice. We talk to these guys. There's one thing of keeping the servicing, but then there's another thing of establishing what you should be booking the servicing on. So we talk about what should we book the value at. That's a critical piece of it, because when you're doing these analytics that Kelton did so beautifully on the fly, every month, every quarter, these numbers move and change. And so it's not a stagnant strategy that you develop at a point in time and think that you just execute over the next year. It's a strategy that you believe in. It's a path that you establish, because you got to find you got to build your own servicing platform, establish a sub-servicing platform. So it's a business strategy and an investment you have to make, and then you have to manage that business over an extended period of time. We love the asset. It's been very good to us from an economic perspective, from a customer perspective, and an overall strategy. But managing the servicing book has 5 or 6 tentacles to it, and you got to have strategies around all of them. And if you do it really well, at the end of the day, it pays off great. So
very, very well put out, and I appreciate that. So, moving forward here, so I want to turn it over to Bob, but to tee this up, so we talk about this strategy, and I'll hit on this well of implementing different strategies of holding servicing, selling pieces of servicing, releasing servicing. But what does that mean in the meantime? It's not a set it and forget it asset by any means.
exactly.
So I want to flip it over to Bob Hamilton here. So Bob is living and breathing managing a servicing portfolio every day. Now, there are a lot of new originators who are recently coming into books, larger books, and are getting their arms around, what does servicing mean to my company from an enterprise level? What are the risks? Who should I be talking to? What are the pitfalls? What sort of oversight should I be implementing on this book? Because in the meantime of implementing any strategy, if you don't manage the servicing portfolio as an asset, it can jump up and bite you. It's a snake that you can't see. So Bob, why don't you give us a little bit of insight of managing the servicing portfolio from your perspective?
We'll do that. First of all, I want to thank everybody for having me speak today. I don't have pretty graphs and charts like Kelton had because we actually do. We're actually working over here servicing loans, and we don't have time to do that. But yeah, so I was asked to go into a lot of originating banks, IMBs, mortgage banks, retain servicing in 2020. We did. And so what do you do now that you've got all this servicing that you didn't have before? Hopefully you were proactive and you strategized um, before you started bringing on all that servicing. We kind of did. Um, but we found out when we strategized in 2019 and made a decision to retain servicing because of all the good things that Kelton mentioned, that we wanted to go over a 10-year period and bring that up to about 10,000 loans. We started off 2020 with about 3,000 loans retained servicing. And guess what? We ended up with 10,000 loans at the end of the year. So we had a 1,000% increase because these marketing guys saw all the gains that they were making on selling loans directly to Fannie and Freddie, and we had to bump our operations up to handle that servicing because Fannie Mae loved us. Man, we were delivering 200 to 300 loans a month, where before we were delivering about 10 loans per month. So again, like I said, I hope those of you that did retain servicing this year were proactive, maybe a little bit more proactive than we were. If you've got a sub-servicer, that's great. Remember, we service in-house, and I'll go into a few of those things if you are going to service in-house. If you're going to use a sub-servicer, obviously, if you're retaining a lot of servicing, you've already got that relationship established. You should have done due diligence on that sub-servicer. You better have some type of a monitoring system built so that you're monitoring that sub-servicer because, again, you are the master servicer when it comes to Fannie, Freddie, and Jenny. You may have a sub-servicer. You may be sitting back in your chair going, I don't have anything to worry about. My sub-servicer is taking care of all the QC compliance issues, CFPB issues. If you screw up, they're going to come to you, and you're going to have to go to your sub-service and fight that one out. Kind of philosophy that I have with sub-servicing is it really depends a lot on your origination portfolio, the quality of your portfolio that you're going to service, retain the servicing on. If you've got a portfolio that you've got really low delinquents on, a lot, depending on what part of the country, and you could have high delinquencies. If you're in our part of the country, our delinquency ratios usually stay below 1%. So what are you paying your sub-servicer to do? Collect payments? So make sure when you're deciding if you're going to use a sub-servicer versus servicing in-house, that economically it makes sense to be paying a sub-servicer to do what they're saying they're going to do. So you need to determine your capacity. We learned that real quickly. What is our capacity? When you're determining capacity, it's not just employees, it's what can your systems handle? What can your staff handle? If your servicing system is built to handle 4,000 to 5,000 loans successfully, you better cut it off somehow and look at either selling that servicing released or setting up a sub-servicer that you've got an outlet to move, move servicing over into that sub-servicer. All right, so you decide you're going to retain your servicing. You can't do it all yourself. Depending on the volume, you need to look at getting vendors to do certain activities for you in your servicing shop. We did. We used to track all of our insurance, hazard insurance, flood insurance, forced place insurance in-house. When you start retaining a whole lot of servicing, the mail coming in from the insurance companies and the compliance issues that you've got with flood, you need to get a vendor that can track that stuff for you. It's well worth the fee. There's vendors out there that have a life of loan fee that they will track that insurance for you throughout the life of the loan. So I would definitely suggest that. Tax service is another thing. If you're paying property taxes in-house, you better get a vendor to do that for you too, because you won't be able to keep up with the volume there as well. So as you all know, we went through 2020. Not only were we bringing on a lot of servicing, originations were going crazy. Payoffs went out through the roof, okay? Because a lot of those higher interest rate loans that you may have had on your portfolio were paying off. You're doing refis, you're turning around and selling those back to Fannie or Freddie. You need to make sure that your staff is keeping up with the payoff volume and the release volume. Every state has got criteria now that you've got to release those mortgages within a certain timetable, or you're gonna get penalized and interest will be assessed towards you. Some of the other things that we ran into: hiring. Okay, if you all of a sudden you decide you're gonna retain servicing, can you hire specialized people to carry that out? Because servicing, there's a big difference between originating loans and servicing loans, especially in the climate we've got now with the pandemic. Hiring is definitely a challenge. I'm sure all of you have faced that over the last year, just trying to get people in to interview them and get them started has been quite the challenge. So think about that too. Think about your staffing, where you're going to get qualified people to do the things that you need to do to properly service that portfolio. We're a commercial bank. We're not a mortgage banker. We're not an IMB. Our accounting department was not real familiar with MSRs, MSR values. You need to make sure that your accounting department is on board with you so that they're recording that asset. Before, when we weren't retaining servicing, we were a cost center. All of a sudden, we started retaining servicing. Guess what? I actually made some income. So I was getting more attention. That MSR value, I got an asset all of a sudden that's worth something that needs to be tracked on a monthly or at least a quarterly basis. And that's where Phoenix and the guys like Kelton, you almost have to be signed up with them so that you know what that MSR value is, so that you can report that to your accounting department to see if they need to write that down or increase that MSR value. Just some things that we learned the hard way. QC is another important thing. You've got QC, I guarantee you, on your origination side. You got to have it on your servicing side too, or Fannie and Freddie are going to be on your butt. When they do their reviews, if you get to a certain point in your servicing portfolio, they're going to ask for your QC plan. There's vendors out there too that can do that QC for you, or you're going to have to hire staff internally to do QC on your loan servicing, which again can be a challenge because servicing again is a whole different ballgame from originations. Am I okay on time, guys?
Yeah, absolutely, Bob.
All right. So what is loan servicing? This sounds kind of stupid, but you need to determine what you're going to do in-house. Servicing includes obviously processing payments, payoffs, processing payoff quotes, escrow analysis, payment of property taxes, insurance, boarding the loans onto your servicing system, borrower intervention, and something that I think we're going to hit hard with in 2021, and that's loss mitigation. When we started retaining servicing, as you know, COVID was right there too. We had borrowers that were originating and going on to forbearance plan the next month after origination. Freddie and Fannie said we could do forbearance plans for a year. A lot of borrowers have taken advantage of that, haven't made a payment for a year. When this moratorium finally goes away, and if I knew when that was going to happen, I'd be making a whole lot more money. All those borrowers are going to have loss mitigation and workouts for them to comply with what Fannie and Freddie say. As you know, the moratorium on foreclosures was extended through the end of January. I see that being extended through the end of March. You need to make sure that you've got reserves set up for that. If you're having to advance interest, and if you're selling to Freddie Mac usually has what they call scheduled actual remittances, where you are going to have to remit scheduled interest to them, but you can hold back your principal. So you're going to have reserves set up so that you can cover those advances. You're going to have reserves set up to cover your escrow advances. Because again, these borrowers aren't making their payments. They're not making their escrow payments. Property taxes come due. Fannie, Freddie, Ginnie all require us to advance funds to protect their interests in those properties. So make sure that you're working with your accounting department to get those reserves set up. What are the risks of retaining servicing? Obviously, market interest rate declines are a risk. I think interest rates are going to be going up, so I don't see that risk happening here. Income, you're getting your income over time versus if you're going to sell the loan servicing release. You're going to have that steady income coming in of at least 1/4 to 0.29% every month, as long as those borrowers are making those payments. You're going to be making money on your late charges, your floats on your reserve accounts, your P&I and T&I accounts, and any ancillary income that comes in. So those are some good things for retaining servicing. Plus, you've got that asset out there that if you need cash right away, you can always sell it that way. Investor reporting is another place that you need to make sure you've got specialized experience. Again, servicing loans for portfolio loans is a whole different ballgame from Fannie Freddie. Fannie Freddie, obviously, you're remitting those payments to them on a monthly or daily basis. Make sure that your servicing system has got the capabilities to handle that investor reporting. We found out that even though our system does, there's still a lot of manual work that has to be done to board those loans on there. Again, Fannie and Freddie love the volume. They don't really care until you might be late on a remittance or late reporting, and then believe me, you're going to hear about it, and that could become a substantial cost for you. I think all of you probably read, it's almost daily, the amount of penalties that are being assessed by the CFPB for servicing, dysfunctional servicing, I'm going to call it. You may not even think you're dysfunctional until you get an audit and they discover things that maybe you didn't. You've got to watch what you're charging fees on. Collections are becoming more and more complicated. When you can call a borrower, can you use email? Can you use text? What kind of warnings or alerts do you need to give your borrowers now if they don't want to receive an email, because you can get yourself in trouble there, and it can cost you some money. I could go on and on and on, but I think I'm going to end it there. And I don't know if we're going to have a question and answer session, but I would be happy to answer any questions. If you've got any questions for me after this meeting, Mortgage Collaborative knows how to get a hold of me. I'd be happy to speak to you. Like I said, our portfolio grew in 2020, 1,000%. So believe me, I've got the bruises, and I would be happy to share some of our experiences with you all. So hopefully you don't have to go through some of the stuff I went through.
No, I greatly appreciate all that, Bob. So just to round us out here before we open up questions, Al, anything else from your side from an independence perspective from owning and managing the mortgage servicing rights?
No, unless I'll leave it to folks to ask questions so that I don't ramble on them.
Okay. So Tom, yeah, let's open it up to any questions from the group.
So as of right now, we don't have any questions in the chat box or in the Q&A, but don't be shy, folks. If you have any questions for Kelton, Al, Stephen, or Bob, go ahead and drop those in the chat. We can verbalize them on your behalf. We'll give it a minute or two here just to see if anyone has anything they would like to ask.
If not, maybe Steve and Kelton could talk about the guaranteed price program you have for any servicing that we retain.
Somebody please ask a question.
My mute button is on all the time now. I'm sorry.
I thought so.
Well, at this point, guys, we don't have any questions in the chat. Looks like we just got one dropped in here. So it says, do you find that lower loan balances trade at lower multiples than a loan at an average loan size?
I'll take a stab at it, and Kelvin can jump in, and Al and Bob, you guys have seen it live, so jump in too. But yeah. So lower loan balances trade lower multiples than average. 100%. Yeah. So that's primarily because servicing fees, as we know, are calculated as a coefficient of the outstanding UPB. And so from a from a get-go, your top line revenue is going to be diminished because of that lower servicing fee. In fact, in terms of dollars, because of that lower loan balance. Now, you might be thinking that, well, hang on, there are spec pools, there are custom pools, less than 85K that trade up, plenty of ticks, if not points, in some markets through TBA. That's very true. And as from a duration perspective, the model does count that into effect. That maybe the duration stretched out a little bit, but at the end of the day, it's just that the revenue stream, there's not much meat on that bone. So that's why we'll always see those priced back, and in a way, it's a different manifestation of what we see on the Govy side. We talk about lower servicing fees, like Kelton mentioned, like the great variance there. But if you're talking about like a 19 basis point servicing fee, in a way, it gets to the same issue as like a lower loan amount, because it's that coefficient revenue calc for your gross revenue that's just going to be so thin on your top line. And as Al and Bob put it very well, there are a lot of potential expenses that could deduct from that top line revenue that just makes it hard to price it as aggressive as, say, an average loan size.
Yeah, and to add on to that, I think a key piece here is, what do you consider lower loan balances? The difference between a $300,000 and a $200,000 average loan balance may not be a material difference at all. In some cases, MSR buyers or models may treat a $250,000 average balance more kindly than a $450,000 average balance or a high balance loan. Really, when you start to get, and it's obviously very geographic centric, just due to the disparity of home prices across the United States. But once you get really under the $100,000 mark, $100,000 average loan balance, and it may be a bit above that, 125, I think maybe even 150 in some case, you start to see the fall off in price. You definitely will see from a market and fair value perspective, even though those do have a little bit longer duration because there's a lower propensity to prepay from those borrowers. Like Stephen said, that the cash flows that's being generated off of those deteriorate, and they're treated as such.
Thank you for that, both Kelton and Stephen, for sharing there. I'm just going to check our chat and make sure there aren't any other questions rolling in.
And I guess one more piece on that is it really, if you're using a sub-servicer, you have a fixed cost of service per loan. As your balance comes down and the servicing fee coming in deteriorates, you can actually be costing yourself every time you're collecting a payment on that piece. Now, in-house servicers have it's not a fixed cost. The more units you add, the more you decrease your marginal cost of service. So it's a little bit different in-house for sub-service. But service, if you're paying that X dollars a month to collect that payment, and that cash flow dips below that payment, you are actually costing yourself money by holding it.
Great point. Thank you, Kelton. All right. Well, at this point, I don't see any additional questions in the chat or Q&A. But if there are any additional questions, certainly feel free to drop them there and we can verbalize them on your behalf. Did just want to mention, as far as programming is concerned, our next keynote starts at 4:30, and it's going to be Debbie Hoffman, CEO and founder of Symmetry Blockchain Advisors. And I'll be sponsored by National MI. And you do have a chance to win a $100 gift card during that session. So you just got to stick on till the end, and we'll announce that winner. But without any other additional questions in the chat or the Q&A, just wanted to say thank you so much to Kelton, Al, Stephen, and Bob. Thank you for all the great information today and for always being willing to talk with our TMC lender members. We greatly appreciate you all and look forward to talking to you more in the future.
Yes, thanks everybody.
Bye now. Thank you.